Did you know that this one simple planning mistake with an HSA ended up costing a family more than $10,000 in taxes? After watching this, you'll understand why this mistake occurred and more importantly, how you can make sure that you don't make the same mistake. My name is Danny Cieniewicz. I'm a CFP professional with 10 years experience. And what I noticed in helping a recent prospect is that they made a major mistake that could have easily been avoided with just a little bit of due diligence. But before we get into that mistake, let's briefly cover the great tax benefits that you can get with a health savings account. HSAs can offer amazing tax benefits. Specifically, you can get tax deductible contributions, there's tax free growth, and more importantly, there's tax free withdrawals for qualified health expenses. There are very few accounts that offer this triple tax benefit, but the HSA is one of them if it's used properly. However, these benefits can disappear and can actually create an adverse tax effect if your beneficiaries aren't properly listed. When it comes to inheriting an HSA, it's important to make sure that if you're married, you list your spouse as the primary beneficiary. There's a pretty distinct difference if you have your spouse listed as a primary beneficiary versus not. When your spouse is the primary beneficiary, you can make sure that the HSA maintains its tax advantage status at your passing. Your spouse can also treat the HSA as if it was his or her own. So as a result, you can get that continued tax-free withdrawal for medical expenses. Also, there's no immediate tax consequences at the passing of the individual who has the HSA. However, if your spouse is not listed as the HSA beneficiary, there are negative consequences that can come. Specifically, the first one is that the entire HSA balance can become taxable income. Secondly, those benefits that you had are permanently lost. The account will then default to your estate, and the spouse loses the opportunity for continued tax-free growth for medical expenses. As you can probably imagine, the larger your HSA balance, the more important this becomes. Let's talk about a recent example about a widow that I met with who unfortunately at the time of her husband's passing did not have her listed as the HSA beneficiary. The account was valued right around $50,000. And that $50,000 was in the 24% tax bracket. At the 24% federal tax rate, that created about a $12,000 federal tax bill due. And obviously, this is a pretty sensitive time, being that she had just lost her spouse, but she's tacked on with an immediate tax bill that wouldn't have been if not for just some proper planning. She also loses the continued benefit of tax-free growth within the account. And with the exception of some medical bills at her husband's death, she's not able to use them moving forward in the tax-advantaged way. Had she instead been listed as the primary beneficiary, she could have treated it as her own, thus saving her $12,000 immediately, but also making sure that the tax-deferred and tax-free withdrawal status would stay in effect so long as she's using it for qualified medical expenses. And while you may be thinking to yourself, how can you possibly miss leaving your spouse as a beneficiary on an account? Unfortunately, it's more common than we care to admit. Common things that come up are recent marriages, divorces, and remarriages. If somebody were to open up a new HSA account and just simply forget to do this, in addition to changing employers and consolidating old HSAs together. There are many reasons why this could have been missed. And while she didn't get into specifics of why this happened, life gets busy. So how do you make sure that your spouse is protected and that your HSA continues to get these great tax benefits? The first thing that you want to do, and it may seem obvious, is to actually check to make sure that your spouse is listed as the primary beneficiary on your HSA. Assuming that he or she is, there's nothing that you need to do in the immediate term. However, if they're not listed as the primary beneficiary, you immediately want to contact the administrator of that HSA plan and make sure that you get the necessary paperwork to complete it and then submit it. Your job's not done after that, though. You want to make sure that you get some level of evidence proving that he or she has been added as the primary beneficiary. Once that's the case, you can then make sure that it's filed properly. So at the time of your passing, your spouse has evidence. Over the course of the long term, there are things that you should be looking to do as well. The first thing is that you're conducting regular beneficiary reviews. Life changes, and sometimes you may switch employers. You may go through a divorce situation or a remarriage situation, or you could find that you consolidate old HSAs or that an HSA plan is being taken over by another one. When this happens, making sure that your beneficiary is properly listed is of the utmost importance because the larger your HSA balance, the more tax advantages that are at your disposal. But in the event that you fail to list your spouse as the primary beneficiary, at your passing, those benefits cease, and it does create an additional tax burden at your passing. And while you're doing this, it's not a bad idea to revisit your legal documents and your beneficiary designations on other accounts. Making sure that your beneficiaries are properly listed can be a very simple thing to do, but it can also be very costly in the event that you don't properly do it. And yes, it may not be costly for you if you're no longer here, but for your loved ones, they'll be the ones that feel the impact of it. It's also not a bad idea to work with professionals on a regular basis of this, whether that be working with a financial professional like my team and I at Hyperion Financial, or working with your tax professional or an estate planning attorney. This information, while it's not difficult to do, can often get overlooked, and you want to make sure that you avoid this mistake. And speaking of tax mistakes that are easily avoidable, we recently uploaded a video about 7 mistakes that people usually make when making Roth conversions. You can check that out by clicking here and making sure that you're able to avoid mistakes when it comes to your HSA, but also if you plan to utilize any Roth conversions.